All right, guys, we're back again for another great episode of PFREI, Passion for Real Estate Investments. I'm your host, Fuquan Bilal. Oh man, this is going to be a great episode. I've been waiting to get this guest on now for 2 years. 2 years. I've been trying to get this guy on my show, and he finally made the opportunity to come. So we're gonna dig in and ask some really good questions. Mr. Lee Arnold. Oh man. Secure Investment Corporation. Let's read your bio real quickly. So, real estate investor, developer, trainer, international speaker, and best-selling author who has spent years perfecting the real estate investing and private lending process. As a CEO of several multi-million-dollar enterprises and the chairman of several private equity funds, Lee has facilitated billions of dollars in real estate transactions across the country as a buyer, lender, consultant. His current success is the result of rebuilding after he's lost everything in the real estate market crash of 2008. We'll talk about that. And this prompted by that experience, he and his family, he and his wife founded the Solution Ministries, a global nonprofit that keeps entrepreneurs live out the truth that God is the CEO and hosts the annual Be Bold. I'm sorry, guys. Be Bold for Jesus conference. Hashtag BBJ. BB4J. Be Bold for Jesus. I like that. The conference provides discipleship training to Christians from all around the world to be bold for Jesus. All right. Now that I screwed up your bio. Welcome to the show, man. I really appreciate it. Let's dig into it. So I like to talk to people who's been through the 2008, right? I've heard the story, and I can relate to it because I went through it and it was similar. You have to pick your face up from the ground and start all over again. But to me, that was the best thing that happened to me. So the first question I always ask the guest, Lee, is why are you passionate for real estate investment?
Well, first of all, for one, thank you for having me on the show. And you said you've been waiting two years to get me on the show. I've been waiting 2 years to be on your show. So I appreciate and am humbled by the invitation, and thank you for allowing me to be here. I am passionate about real estate because I don't believe that there's anything else on this planet that can change the lives of so many people so quickly. From the properties we acquire. We work with some of the worst properties in markets across the country. We do a lot of work with municipalities and code enforcement in coming in and cleaning up blight and taking properties that were riddled with crime and just the wrong type of activity taking place. And we come in and we clean it up. And we put a nice family in there that's going to take care of it and take care of the neighborhood. And lives are changed as a result of that. So I like what real estate can do for people. That's why I'm passionate about it.
Yeah, thanks for sharing. Now, your journey, it hasn't always been real estate. You didn't come out the womb and start flipping houses. Let's talk about the journey a little bit. How did you get your start and what led up to that market crash in 2008 that kind of really taught you these life lessons?
Yeah. Well, I grew up on a farm. So my background is farming. And my dad was a HR manager at a bank, and my mom was a stay-at-home mom. So we didn't have a lot of money. We would have been considered lower middle class, but we lived on acreage. So I grew up playing with dirt and harvesting alfalfa and throwing hay. So no background in real estate. And when I was 18 years old, I saw an infomercial on TV that said, if you come to the DoubleTree Hotel, we're going to teach you how to get rich in real estate. If you remember the infomercials of the 90s, and being young and dumb, I believed them. I went to one of these 2-hour preview seminars, and at the end of the 2 hours, they convinced me to give them all of my money and mortgage my truck. So I had to get a loan against my car to pay for these trainings, which, looking back, was the best thing that could have happened because there was no second option. I had to make this work. It's the equivalent of burning the ships, right? We're not going back to England, so we better win the war. And so I came out and I did my first deal when I was 18 years old. Partnered with the pharmacist at the grocery store that I was working at that time, making $3.90 an hour. I like to tell people that my first deal was financed by a drug dealer because it's far more embarrassing. Uh, but he and I partnered up on this deal together, and we made a $29,000 profit, and we split that. Now, when you split a $29,000 profit and you're 18 years old making $390 an hour, that's roughly $7,300 a year. So on one transaction, I produced 3 years of income working at my job.
Mm.
And so I decided at that moment that real estate was going to be my career, my path. I dropped out of college. I was attending college at that time. I dropped out. I said, real estate's going to be what I do. And so from that point forward, I was on this massive upward trajectory, and I started getting pretty full of myself and thinking that I had the Midas
Yeah, yeah,
touch.
yeah. I can relate.
You
I
know,
can relate.
the project started getting bigger and the numbers getting larger. And when 2008 came, I had over $40 million worth of ground up construction coming out of the ground on luxury homes. Now, when I say luxury homes, our retail sales price on 3 of these houses was $22 million a piece.
Wow.
14,000 square foot, ski in, ski out, glass elevators. I
Wow.
mean, these things were ornate and over the top. We had a full page ad in Ski Magazine, August, or it was July of 2008. And then in August, Bear Stearns goes down, September, Lehman goes down, then Countrywide goes under, and then Greenpoint goes under. And all of the people that we were getting loans from literally went bankrupt, like within 30 days. And I lost everything. I had 90 rental properties, lost most of them to foreclosure. I short sold some of them. All of my luxury ski and ski out houses, I had to short sell those off. Even my primary residence, I had to short sell. So fortunately, I didn't file bankruptcy. Everybody advised me to do that, but I didn't because all bankruptcy is renegotiating with creditors. So
Right.
I decided to take that on myself, and I went out and renegotiated with all of my creditors and was able to get everybody taken care of without filing bankruptcy. Now, it took everything I had. So in 2009, my wife and I, looking for a fresh start, we left Salt Lake City where we were living at that time, and we moved up to Spokane, Washington, which is right next to Coeur d'Alene, Idaho, which is where I'm sitting right now. So I'm about 100 miles south of the Canadian border. But what I learned from that experience is don't be too big for your britches. And I left the very thing that had made me rich and threw it all on black, expecting to get even richer. And man, the market came and just smacked me hard and taught me some really good lessons, which I'm grateful for, like you. But I believe it's made me a better investor. It's made me a better fund manager. And all of our thousands of investors around the country that do business with us are benefiting because of that experience.
Yeah. So I have this thing I trademark. It's called diversified hybrid real estate investing. And I actually trademarked that. And it's really just having a two-prong approach, more than just one approach to driving revenue to the fund or your investment vehicle. And I see you have some similarities with that because you actually are in the note business, you originate, you sell off notes, and then also you have some rental income. You kind of have that diverse strategy. That was one of the things that my biggest takeaway from 2008, because I was a one-trick pony. I was just doing fix and flips, and I was forced to be a landlord after the banks wouldn't finance anymore my fix and flips. And I think that's important today. So what are some of your biggest takeaways from that time that's really helping you navigate through the times that we're in now?
Well, if we go back to 2008, right, the market's in turmoil. 2009, everybody's trying to figure out what happened. It's like the bomb went off and all the dust is settling and people are still trying to figure out where they are. By 2010, we start seeing an increase in foreclosure filings, a ton of properties going to the courthouse steps, foreclosures rampant. And then Obama comes out with something that's going to, fix the market. And the first thing he came out with was if you remember this, the buy the junker trade-in program. So if you got a junker car, bring it to any car dealer and they'll give you $4,500 no matter what condition. So he did that to spur the automobile industry, which employs millions of people. So great. The next thing he did is he dropped interest rates and he created new loan programs for affordable housing buyers, which is first or second time home buyers whose financing is going to be coming through FHA or VA. So he threw literally billions of dollars at these loan programs and started spurring the real estate industry to get people to buy again. We know that every time somebody buys a house, within the first 12 months of purchasing that property, they're going to spend 10% of the purchase price on consumables, refrigerators, couches, decor, all of these things. So if you can get real estate moving, you can get the economy back on track. So he starts throwing money at all these loan programs. And what I noticed about it is none of this money was available to anybody above the FHA cap. All of it was for FHA VA financing. And I said, okay, here's what we're going to do. We're not going to flip houses anymore. We're not going to buy houses anymore. We're not going to touch anything if our retail sales price or our target goal of selling exceeds the FHA cap. Because if the market shifts and a recession is trending, there's still going to be money available for FHA and VA buyers. So for the last 13 years, we have not bought a house that exceeds the FHA cap in any market. We also discovered that the most rentable property is a home that is 2,800 square feet or smaller, a property that has less than 5 bedrooms and 3 baths, a property that sits on less than half of an acre of ground, and is either a single family duplex, triplex, or fourplex. Those were the sweet spot criteria, and 80% of all housing stock in the US fits into that 5-point buy box I just gave you.
Yeah.
So we started investing in just those properties. And when we started lending, we said, you know what? We're not going to do what all of our competitors do. There's a lot of lenders out there. You can go get a loan to do ground up multifamily, ground up commercial, ground up industrial. There's a million lenders out there that'll do that stuff. And we said, we're not going to do any of that. We're going to focus on these 5 things, and that's it. And we're going to underwrite every loan to these 5 things, and that's it. Faquan, do you know what you call a hard money lender in a recessionary downturn?
No, what do you call it?
Landlord.
Yeah.
Right.
And that you want to set yourself up to be in that position. That's what I didn't do. And that's why I failed in 2008.
Yep. So if any of our borrowers, and we've lent hundreds of millions of dollars around the US, if any of our borrowers at any time default, we have a property that fits into the 80% category that government funding will be available for. And if we can't get it sold, we can rent it to at least cover the monthly debt obligation that is against that asset. So here's a prime example. A year ago, Faquan, we had 100 properties that we had bought, and they were ready for sale. And as the market started shifting, our prices started going lower and lower and lower, trying to get these things sold off. But once we got to a point where it was break even or loss, we're like, we'll just keep it. And so we took all 100 of those properties and we just turned them into inventory that we're now renting out. And we're generating just as much cash flow from rents as we were generating when we were collecting payments from the borrower. So the nice thing about this is we run a debt fund. We have 3 private equity funds. They're all debt funds. And the nice thing about it is because we lend on assets that can immediately create cash flow, we don't have, half-built properties that you can't put a tenant in and collect rents. And so this ensures that our investors are going to get a check every month, every quarter with great consistency because we have such a strong portfolio of assets that cash flow.
Got it. Yeah. Thanks for the value add and the share. Let's pivot now to the current market space and the challenges, right? So I was telling somebody the other day, I was like, look, I'm not bulletproof. I don't have a crystal ball. I'm putting things in place. Even with all my experience, things can happen and can shift that's out of my control. As long as I'm stress testing when I'm buying, I'm underwriting properly, and I'm buying great deals instead of good deals, I think I would be okay. But what are you seeing? What are some of the challenges that you see you guys face in the markets where you are? And then what are you doing to mitigate that risk?
The biggest challenge that currently exists in the market is that the market, and when I say market, I'm referring to the seller. The seller has not come to grips with the reality of where the market is and where it's going. And if you look at the buildup of 2020, 2021, 2022, just skyrocketing. But then in June of 22, we peaked. Every market around the country pretty much peaked, and everything started trending downward. But instead of selling, discounting the property to a point it would sell, what sellers were doing is they were just discounting it $1,000, $500, $1,000.
Yeah.
Right? So what they should have done is they should have discounted in front of the trend line. So a lot of inventory got trapped in this discounting cycle. And you know as well as I do that aged inventory is troubled inventory in the mind of the consumer. So the sellers haven't realized just how far the market has slid, and so they're not pricing their properties at a number that will sell yet. Because of that, we're not getting the sales that we need to readjust the dollar per square foot that Zillow reports in what's called the Zestimate.
Yeah.
Now, sadly, Zillow has become the gospel of value to the uneducated consumer. And until we see some of these forced sales, these motivated, I got to get out sales, we're not going to see the Zestimate adjusting to the right number. And I believe that that's going to happen late Q2, Q3 of 23 of this year. And when that occurs, it's going to be the biggest buy opportunity we've seen since 2010 and 2011. Now, I'm pretty excited about it. Now, in 2010, you know as well as I do, the deals were amazing, right?
Yes. Yes.
Oh my goodness, the deals were so sweet, but I was licking my wounds from doing stupid
Yeah,
stuff.
me too. Me too.
So this time, we have been systematically stockpiling cash, storing up liquidity to take advantage of some of these opportunities that are coming online. There's no bad time to buy real estate, just the wrong strategy to buy real estate in that particular market cycle. So the other adjustment that we're making is where we used to make all cash offers, close in 7 days. Now we're coming in and we're writing offers subject to seller financing. And we're getting sellers to carry rates for us at 2.5% and 3%, even though the feds have been jacking rates, what are we at now? 4.75 with 3 more increases in Q1 of 23 planned. We're going to be seeing 8.5%, 9% rates by the end of Q1, in my opinion. And meanwhile, we're getting sellers to carry and sellers their house at 2.5% and 3% interest.
Yeah.
The other thing we're doing, Faquan, is we're going after mortgages originated in 2020, 21, early 2022, where these people bought these properties at the peak of the market, but they got rates still at really good rates, 2.5%, 3%, and we're just taking those over subject to as well. So yes, the market is shifting, prices are falling. People are going to find themselves upside down in a dramatic way in Q2 and 3. We're going to see a spike in foreclosure. And prices will fall as a result of that. So it's going to be an amazing time to be in real estate and to be buying real estate.
Yeah, I mean, I appreciate that insight. I have a different take on it. If you allow me to share with you.
Yeah.
And it's not, I mean, neither one of us could be right. We don't have a crystal ball, but I'm preparing for the next 24 months of the market just being at this position where inflation is trying to be controlled and the recession is going to come. We're going to have that lag. And then probably somewhere around Q4 of 2020, 2024, the rates would start dropping and things would swing, maybe sooner than that. But I'm just preparing now, for my PTSD. Hey, just strap your boots up for this next 24 months, build as much cash flow as you can, and pretty much go. I mean, in our marketplace where we're 20 minutes away from the city. We still have people coming over from New York. So, we're building quality houses, ground up stuff. So we still have a buyer market for that stuff, and it's still selling as of now. And I think we have the strongest market where we are in the Northeast, a little bit different from the West and Midwest, but it's just all over different things, but we're just preparing and planning we're planning to fail actually. And I mean that by we have plan B, plan C, plan D. Right. So we're not like what Mike Tyson said, nobody, till you get punched in the face, I forgot what the saying, everybody has an answer or something to get punched in the face. You know what the saying.
Everybody has a plan until they get
punched in the face. Yeah. So we're planning to get punched in the face, actually. So 24 months, even if 2023, all this inventory come up, that's going to, drive prices down, which is going to, hurt sellers on the exit. So we'll see what happens. If interest rates still up and there's an abundance of inventory, it's a good opportunity for people who are in a liquid position to go in and buy stuff. But when they go to sell, it's going to be the same thing because it's not just going to boom up. So it's, buy it and you wait and rent, cash flow. And then once things turn around early 25 and market values start to go up as interest rates go down, you can exit. That's kind of what I'm seeing. I mean, neither one of us could be right, but that's what I'm preparing for.
Well, I think we're both right and we're both wrong. And you alluded to this earlier, Faquan, when you said it all boils down to the underwrite, right? And by underwriting, what we mean by that is simply looking at the numbers and make sure that the deal pencils. The way that we are changing our underwriting, knowing that we're probably going to be carrying the bulk of the inventory that we acquire over the next 24 to 36 months, we are underwriting the file so that the income covers the debt service.
Yes,
So if that's not true, then we're not going to do the deal.
absolutely.
Now, prior to the recessionary downturn, we were more than willing to take a negative debt coverage scenario because the market was going up and we were selling into a higher price point. So
Yes.
the negative debt coverage was mitigated, but not in the market we are in and heading deeper into. If it won't cash flow as it sits the way you write it, then I would encourage either go back to the seller and negotiate better terms so you can get your capital costs below your income, or don't buy it.
Yeah.
That's critical, because if you are not generating cash flow greater than your expenses, if that timeline exceeds 24 months, you're in big trouble. Right. So if you only underwrite expecting a 12-month cycle before things change, you're going to run out of money. And that's what happened to me in 2008 is I kept throwing money at the problem thinking that the market would come around quicker than it did. It took 3 years longer than I expected, and I was out of money 3 years ago.
Yeah.
So
Yeah.
cash flow is key. It's critical. Without it, you're done.
100%. Let's talk about the lending side of the business. So you guys are doing notes for people who are buying and renovating, and there's still a market for that, as long as they can buy them at the right price and you give them a loan. Are you guys focusing more on generating more rental cash flow, or generating more revenue from the notes, a little bit of both? And on the note side, I got to imagine when those low coupons were out there, from the origination side, and now interest has increased. Like if there's some note investors saying, I can't wait till this thing redeems so I can, give another origination and catch the upside of where the market is now. I mean, there's a little coupon. Let's talk about that side a little bit on the note side.
Well, we are pretty unique in that, unlike most of our competitors, other lenders in our space, most of their capital is either coming from Wall Street or private equity backed by Wall Street, or even banks, where the Fed rate adjusts all of the capital costs to those lenders. And so we've been seeing all of our competitors' rates rising, right, from 6 to 7 to 8 to 9 to 10 to 11. I had a client call us the other day and say they just got quoted 14% from somebody who a year ago was putting money on the street at 6.
Yeah.
Now, we're unique in that our rate is 8.99. Because we don't have a single dollar from private equity. We don't have a single dollar from banks. We don't have a single dollar from anything that's tied to LIBOR or Fed funds rate. It's all private money, right? Our money comes from people watching your show, Faquan, and thousands of other investors around the country. So we tell them, look, we're going to give you a pref of 6 or 9, depending on which fund you're in, and we're going to determine which fund that goes into. But we start at 8.99, and we've been at that rate for the last 4 years.
Yeah.
It has not risen. It will not rise. We're at 8.99, which is interesting because by the end of March of this year, we're going to be cheaper than conventional loans in many markets, which I find very, very funny. But yeah, for when we're writing these loans, we are underwriting them to the same 5-point criteria buy box that we have. And we are also underwriting it on behalf of our borrower to say, okay, if you can't sell it, will the market rents in your area, because we lend in 46 states, will the market rents in your area cover your debt service to us so that we can pay our investors? And if the answer to that question for them is no, we don't write the loan.
Yeah.
So that's the biggest change to how we're lending, where we're lending, what we're lending.
Are you guys changing some of the criteria to the borrowers, like having them put up more reserves? Figuring out how they're stress testing certain things. Like there's some lenders who go, hey, you need, instead of a 6 months reserves or a year reserves, we want to do 2-year reserve. We want you to put more money up front, whatever it is. You guys are implementing all of that, right, in this marketplace?
Not at the front.
Okay.
We've seen a lot of our competitors change kind of their front end marketing funnels to be more restrictive to come in.
Yeah.
I've always said, if you were the important piece of investing in real estate, none of us would have ever been able to get started. Because when I bought my first house, my truck payment was 3 months in arrears, my credit was jacked, I didn't have two nickels rubbed together. So I'm less concerned about the money that the operator has, the experience the operator has. I'm most concerned with what is the deal, where is the deal, what are the economics of the deal, and if they fail, is it still a sound investment? Now, if the investment is sound, okay, this deal makes sense to me. This is going to cash flow. Now I'm going to look at the borrower and I'm going to say, okay, worst case scenario, what are you capable of achieving? One, can you complete the project? Do you have the capacity to get it done, the competency to finish this project? And if I feel like maybe you are going to need some help, I'm probably going to require more money down. I'm going to require more money in reserves. I'm going to increase the interest rate because our risk profile has increased. So I want to look at everybody. I don't want to restrict people from coming to us on the front. I want them to bring me their deal. Let me look at it because, like I said, if somebody was looking at me as a borrower back in 1995 when I started doing this, I wouldn't be sitting here today because somebody had to look past all of my financial issues and look at the deal. And so as a lender, that's our number one priority is, do you have a good deal? And then we will mitigate risk through our underwriting from that point. But we haven't changed our LTVs. We haven't changed our pricing structure. We've done nothing because I felt like what we had installed before the recessionary downturn was good underwriting then, and it's good underwriting now.
Yeah, that's awesome, man. That's really great information. I also want to plug your book, Millionaire Shoes. Have it right here. And I was reading, and I saw this quote by Louis L'Amour. Is it Louis L'Amour? The Victory Lap. Yep. Victory is won not in miles, but in inches. Win a little now, hold your ground, and later win a little more. I like that. Yeah. This is a good read. And you want to talk about that a little bit? The Millionaire Shoes?
Yeah. I wrote Millionaire Shoes in 2007. And I did an update of Millionaire Shoes
2019.
2019.
Yeah.
And I try to do an update every year because the amount that I learn on an annual basis changes. And so my entire career and my success in this business has been built simply by doing what other smart people are already doing. I'm not that intelligent. I'm a college dropout. I'm not trying to reinvent the wheel. I'm just trying to find the best business practices that are sound, that make sense, and just try to build a better mousetrap. And so Millionaire Shoes is really built around that concept of, you guys don't need to go figure all of this stuff out for yourself. There's people already doing it. Just follow their lead. And the fact that you're here, listening to Fuquan's show and taking in all of the information that he's sharing with you guys, you are so much better equipped to be successful at this than I ever was. But that's the basis of the book, Fuquan, is just finding good quality mentors and just doing what they tell you to do. That's what I do.
Yeah, make sure you guys check out securedinvestmentcorp.com, be bold, the number 4jesus.org. And also, if you're interested in the fund information, check out Kogo Capital, COGO Capital.com. Yeah, man, I know your Facebook is He's the Solution, HES the Solution. And Instagram is the same thing, He's the Solution. Make sure you guys check them out. Happy to see you on IG. Yeah, I mean, any parting words you want to share with our guests? I really appreciate you adding a lot of value to the show. Any words of wisdom you want to leave our guests with?
Well, I would say for anybody that might be interested in real estate investing, we do an 8-hour training every Wednesday. If they'd like to check that out, is that okay if I invite them to that?
Absolutely. Let's do it.
You guys go to fundingtour.com, fundingtour.com. It's free. There's no cost. But it's an 8-hour presentation where we're going to teach you how to find deals, the types of deals to look for, the situation, the seller scenario. And the reason that we do this is we're a nationwide private money lender, and we can't lend money until you guys find great deals. So we will train you, no cost, to go find great deals. All we ask is that when you find them, you bring them to us so we can lend you the money. Funding to
Absolutely. Yeah. Value, value, value. I like it, man. And
Words of wisdom, Faquan, I would say this. Here's my favorite quote. Don't leave your success in the hands of others. And what I mean by that is if you're waiting around for your employer to give you an increase to make you rich, if you're waiting around for brother, cousin, aunt, uncle, sister, brother, mom, dad to show you the way, look, if they're not already earning the income that you want to be earning, they don't know how to earn the income that you want to be learning. The amount of knowledge and information you currently have is capable of producing the income that you're currently getting. And so the
mm,
only way to increase your earnings is to increase your knowledge. And that's only going to come from following people that are already generating the income that you desire. So mentorship is critical. And that's the path to success.
wow. Can you repeat that again? I'm just kidding. That was awesome. We'll make sure we loop it up so they can hear it twice because it takes 7 times for somebody to hear something to really take
Right.
action. Thanks for coming on the show. Another great episode of PFREI, a passion for real estate investments. I'm your host, Fuquan Bilal. Today we had Lee Arnold. This was a great interview, man. I know we were talking before the show. You said it's negative, was it -8? I said it's 11 degrees here. You was like, dude, it's -8. I'm happy to be in Jersey.
It's cold, Bhagwan.
Enjoy the rest of the year, man. If I don't see you or speak to you for the end of the year, happy new year and happy holidays to you and your family. Appreciate you coming on the show, man.
To you as well. Thanks, Bhagwan. Appreciate it. God bless you. Merry Christmas and Happy New Year, everybody.
Awesome.